All right. This week, we're going to finish the chapter 11 and move on to chapter 12, right? This is international banking chapter, right? Um, and then this time we're going to talk about something called the LIBOR, which is stand for London Interbank Offer Rate, right? London Interbank Offer Rate. What is this about? Well, this is about the short-term borrowing rate, right, among the major banks in London, right? So what do I have over here, by the way? This is a hat that I purchased in London, by the way. This is Derby's, right? Officially, this is a hat typically worn by those bankers in London, right? So that's why, as a souvenir, I'm wearing this, right? I hope you like it. Even if you don't like it, you have to pretend that you like it, okay? So the hatters over here, it says major, you see it over there, right? And then inside of it, right, you see a lot of the beautiful silver, okay, covered, okay, inside those hat. And then this is made of 100% wool made, okay, designed in England, right? So that's this. And you've seen that JP Morgan's picture, right? He also had a big hat, right, which has very luxurious silk made ones, right? That kind of thing, right? A tall one is much more expensive. I checked their price. It was like £1,000 or something. This one is about £100 plus, right? 150 or something. So it has to do with the social status, I guess. And now the London Interbank Offer Rate. So what is this about, right? Let's see. This is a reference rate in London or euro currency deposits, and there is a LIBOR for euro dollars, and then euro Canadian dollars and euro yen, and even euros, euro, right? And then right now this LIBOR fixing, we call it fixing, right? LIBOR pricing kind of things. LIBOR fixing is done in the ICE, right? Yeah, organization. Okay, so you go ahead and check out this web site, and then you will be able to see what's going on over there. In other financial centers, other reference rates are used. Okay, for example, SIBOR stands for Singapore Interbank Offer Rate, and TIBOR stands for Tokyo Interbank Offer Rate, right? And then Euro Interbank Offer Rate is also there, and we call it Euribor. This is the rate at which interbank deposits of the euro are offered by one prime bank to another in Eurozone. Now, this LIBOR, by the way, is by far the most frequently used reference rate, okay, especially in derivatives pricing, okay, swap market or call option, put option, all these kind of option transactions. 350 trillion US dollars, or let's see, let's check out the size of the market later on. Massive size of it, okay, $350 billion. Okay, anyway, so institutional detail of LIBOR fixing works like this. Simply because this is the most frequently used, widely used reference rate, right? You may wonder, this is fixed in a very scientific way, okay? But that's not the case. Okay, that's not the case. It works like this. Every 11 a.m., every trading day, okay, in London, the representative traders of the BBA, British Bankers Association's LIBOR panel banks get together, okay? Of course, in tens of years ago, they must have been meeting offline, okay? These days, online, right? Get together and then give their opinion or estimate about the following question, okay? you have to answer this question if you are the representative of Barclays or something like that. At which rate your bank could borrow in euro currency market? Hey, is there something strange? Me, HSBC banker, and you are asking me about at which rate HSBC could borrow overnight, right? Instead of asking me about HSBC banker to evaluate Barclays Bank or other Bank of America, how much of a rate that I have to charge when they borrow from me, right? Me, well, if you ask me, HSBC seems great all the time. Who would ever, try to say any higher rate? Okay, that is first question, by the way. But anyway, they do this kind of survey to 17 different banks around. Okay, you're gonna see the list of it, and then 17 or more. Okay, and then they list up those rates. Okay, and then rank those rates, and then top 25% and bottom 25% they take out, and then the remaining 50%, based on this you take the average. That is going to be the LIBOR rate of today, 24 hours. Okay, now who wants to say a higher rate is the first question. Okay, because you want a lower borrowing cost, right? And they are asking your personal opinion, right? And then, of course, it's not a personal opinion, but official opinion, I guess. But that is still a subject to your bias, personal bias, right? Anyway, so LIBOR panel banks these days, 17 of them are listed in British Bankers Association website. So Bank of America, U.S. Bank. Okay, isn't it British Bankers Association? But this is Global Banking Center, so that's why we have major banks from the US. Tokyo Mitsubishi UFJ, wow, Japanese bank. Oh, how come? But then, do we have any Chinese bank or any Korean bank? No. Why no? I don't know. Maybe the list of these Bankers Association list was made in 1990s when Japanese banks were flying high. Barclays Bank is there, right? That's UK bank. Citibank, US, yes. Crédit Agricole, French bank, right? Credit Suisse, understandable, yeah. And then Deutsche Bank, right? Of course, they have to be there. HSBC, UK bank. Of course, the name is misleading. Hong Kong, Shanghai, right? Not Chinese bank. British bank. And JP Morgan Chase, US bank. Yes. Lloyd's Banking Group. Yeah, it's there. Okay. And then Rabo Bank. Rabo. What is that? Okay, who are you? Sorry, Rabo. Tipo Bank, right? But still there. This is British one, so that's why. Royal Bank of Canada, CA Canada, right? Societe Generale, the French bank, and Sumitomo Mitsui Banking Corporation Europe, right? That's Japanese one. And Nori Shinchukin Bank. What is that? That's Japanese one. Okay, it's like a farm agricultural bank of Japan. Royal Bank of Scotland is there, RBS, and UBS, the Swiss bank, is also there. So 17 of them. You can see that this is multinational list of banks, right? Major banks, perhaps used to be major banks in 90s or 80s, but some of them are not. But LIBOR fixing scandal has been an issue since 2009 and 8. And the textbook describes in detail about that situation, 274 and 276 to 7. You go ahead and read this part of the textbook, okay? And then also I posted a Forbes magazine article on iCampus. Also I posted a Korean news article that popped up, published a week ago, okay? Associated with LIBOR scandal, right? LIBOR fixing scandal. What was the problem over there? LIBOR fixing scandal. You remember this question: at which rate your bank could borrow you in euro currency market is the question, right? Who wants to stay a higher rate is the first question, okay? And that in the middle of global financial crisis in 2008, right? The idea is in financial crisis, it's a banking crisis, right? Banking crisis. So the bank, your bank, without any exceptions, must be very unstable and risky, which means your borrowing rate has to go up. But they didn't say higher rate than previous, period during this financial crisis. Why? Because they wanted to mislead to their advantage so that they could still borrow at the lower rate, okay? And then do business, keep on doing business somehow. That was the first crime, okay? Deceiving the market. And number two, much of the derivatives pricing depends on your survey results, right? Now, $350 trillion worth, right? Trillion. Oh my God, of transaction in derivatives is going on in every years, right? Nobody is policing upon you. And then who wants to say honest number in this case, right? So there were people detected some collusion among these bankers, right, the traders, to manipulate this LIBOR, which is a lying in massive scale, right? So that turns out to be a huge problem, and this was detected in 2012. What was the consequence, right? What was the consequence? One trader was sentenced to 14-year prison term, right? 14-year, right? And there were multiple traders. Those guys are still waiting for the how do you say, verdict, okay? Sentence, right? Still to be made. And then they're going to be punished severely. And then US and UK regulators imposed more than $6 billion in penalties on member banks like UBS and the Bank of America, all these guys, right? So that was what was happening. And then Barclays CEO got fired because of this. And then moreover, they're dumping LIBOR by 2021. They say they're going to replace it with something called BTFR. What is BTFR? I know BTS, but BTFR, Broad Treasury Financing Rate. Okay, this contains a broad set of U.S. Treasury market-based financing transactions, also known as repo transactions. Repo stands for what? Repurchasing agreement. So this is a short-term borrowing, borrowing scheme that you first, you as a borrower start with U.S. Treasury security that you have, okay? This is a Treasury security, this is not a cash, but what you need is cash. So you want to borrow certain amount from a bank, but the bank requires you some kind of pledge or collateral, right? So you use this U.S. Treasury as a collateral, and then here's my collateral, U.S. Treasury, the safest asset, so give me cash overnight or a couple of days, right? And then this, I make a repurchasing agreement to you, okay? It is a borrowing, okay? It is a borrowing, but in the formation part, I make a repurchasing agreement that I will repurchase the U.S. Treasury that I pledge to you, okay? Here is my pledge. I'm going to repurchase this later on, a couple of days later. So repo is going on. Anyway, so that's it. And then we're going to talk about international debt crisis, right? Debt crisis. All right. So international debt crisis. Some of the largest banks in the world were endangered when the loans were made to sovereign governments of some less developed countries or emerging market countries. Actually, this goes almost together with the currency crisis. We call them twin crisis, right? If you remember chapter 1, we talked about Mexican peso crisis and East Asian financial crisis and 2008 and 9 global financial crisis, right? That was discussed in from the perspective of currency crisis, FX risk, right? Korean won, its value, right, is devalued, right? Especially right after the change in currency regime from fixed currency regime to floating or freely moving currency regime. You experience this kind of currency crisis, especially when it is coupled together with some asset market bubble and its burst, right? Now, this chapter we talk about this similar event or almost the same events, right, from the perspective of debt crisis. So this currency crisis and this debt or banking crisis happen together, so that we call it twin crisis, right? So currency crisis, it's scary, and then the another one, banking crisis, happen together, just like a hydra attacking you at the same time, right? So you're going to be spooked in two different ways. Why does this thing happen in simultaneously? Why is it a hydra that has two heads in one body happening at the same time? Because it's related to global banks and then the global international borrowing, those that is linked together, right? Associating the FX risk as well as the banking, right? Interest rate risk itself, right? So they're happening together, okay? Usually. So let's look at it from the banking's perspective, right? At the height of its crisis, third world countries owed about $1.2 trillion, right? Like many calamities, it is easy to see in retrospect that it is a bad idea to put too many eggs in one basket, especially if you don't know much about the basket. Now, because 1997 financial crisis, East Asian crisis, directly hit Korea, right? I can tell you something about this, right? Some of these dramatic cases. Here, what you see is, well, CD is starting to say something to me, but let's not get bothered. Come on. Now, there was a company called Daewoo Motors, right? Daewoo Motors, led by the late Kim Woo-jung, right? Woo-jung Kim, right? He was a very famous businessman, right? Right before the financial crisis, he published a book in Korea that was titled 세계는 넓고 할 일은 많다. The world is big and there are a lot of enterprises you can do, right? Be ambitious. Boys, be ambitious kind of book, right? That is very inspiring. That was very inspiring. And then heading for globalization and then working all over the world, right? That was very remarkable. He was a very iconic guy, right? Iconic figure in South Korea, because he was the one who was building factories in Eastern Europe, and then building joint ventures over there in Poland, and then Skoda Motors and things like that, producing Daewoo Motors over there. Which was unprecedented in Korean business history. So very ambitious one, inspiring one, okay? But the problem was, in that era, you were going to see that those major businesses like chaebols or all the companies, they were doing businesses with borrowed money, okay? Borrowed money. For example, the debt to equity ratio, I'm going to show you later on. But if you look at their balance sheet, right? Balance sheet, over here, asset and debt and equity, right? Debt and equity, can you see it? Let me expand it. Okay, debt plus equity should be an asset. I'm gonna turn this thing off, right? maybe you could see clearer, right? So typically, right? Typically, the debt to equity ratio, okay, in the U.S. firms is like average 20 to 30%, okay, debt over equity, okay. But the chaebol in Korea, right? The chaebols in Korea, they had about like 4-to-1 ratio, which is like a 400% plus, okay, like 1,000% or something, even more. Okay, can you imagine this kind of business, right? Where this kind of capital structure unimaginable in the U.S. Only those banks, right? Their financial institution keep this kind of balance sheets, the debt to equity ratio. But for manufacturing companies, they do it like this in America. But it was like this in Korea. Okay? Why was that the case? Because they had special relations with the government. Okay? It's called the crony capitalism, right? The CEO is well connected to the government, the, the president of Korea or something, so that the banks, right? The bank is influenced by the president of Korea, and then the government guarantees Daewoo Motor or Samsung or whatever. So much so that the banks don't have to worry about lending money to these guys, right? There will be no bankruptcy. It's like God. They're gonna go on forever. So lend them money. Well, given that kind of economic environment, those business people had more reason to depend on bankers' money. Okay, the bank borrowing, right? A highly leveraged position. Okay, that created a moral hazard, right? What if this company goes bankrupt? What if this company goes bankrupt? Well, equity holders lose 100% of their investment, wipes off, right? The equity holders lose 100% of what they invested. But the trouble is, these bankers, right? The bankers, they are in trouble, right? And the bankers, they are in trouble, but in the end, that means the depositor to Shinhan Bank or Kookmin Bank or Uri Bank, those depositors' money gets in over here and they are in trouble, which means those taxpayers were screwed when once this kind of chaebols went bankrupt. Okay? The thing is, until 1997, okay, they did not go bankrupt because the government protected very well, okay, and there was no chance of going bankruptcy. But with the liberalization of the capital market, moving from the fixed exchange regime to freely moving exchange regime, following OECD rules, right? The economic size of the Korean economy grew mature enough, so much so that they now had to liberalize all these kind of things. And then the thing is, let's focus on Daewoo, right? Those debt amount they had, right? Significant part of it came from foreign currency, not just in domestic, right? Domestic currency, but in foreign currency. They had borrowed a lot of amount from Citibank or Bank of America or whatever the international banks, Deutsche Bank, whatever. Okay, they borrowed a lot of dollars. Okay, and that in the short run. And now, guess what happens when the currency, Korean won, devalues, whereas the US dollar value goes up? This debt amount explodes, right? Compared to your equity value, you're in trouble, right? So eventually all of those chaebols were in trouble and somebody had to be a scapegoat, I guess. Unfortunate guy, Kim Woo-jung, was, had to declare bankruptcy, okay? And perhaps he was the wildest guys to expand in that sense, expanding too much outside. So that may be partially why. And then there came, with this bankruptcy of these companies, right, or whole group of Daewoo was going down. The trouble is they took up so much portion of the country's GDP, so much so that their bankruptcy meant whole lot of disaster for all aspect of economy, right? About like 5% or more of the GDP must have gone down, and then because of this, and then employment, there are a lot of unemployment problems going on, social unrest, all these kind of things were unfolding in 1997 and 8. And there was an issue like this. Oh, the Daewoo Motors, right? The second largest car manufacturer in Korea, following Hyundai. Is it going to be sold to somebody outside, right? To foreign companies was a primary issue over there because a lot of laborers and the workers were involved, were employed by this Daewoo Motors. And once this Daewoo Motor is taken over by foreign investors or foreign companies, the next thing they would do is those foreign companies would do is restructuring and laying off the employees, right? So what will happen to their job security, and would there be some political unrest, okay, social unrest associated with it, was a primary concern. Now, in this kind of crisis situation, right, banking crisis, we can think about this Daewoo Motor kind of companies, which I show it with blue box over here, LDC firm, lowly developed countries market company, low developed countries firms, right? Daewoo Motors, right? For example, okay. Now I said they had a lot of borrowings from the foreign banks. For example, Bank of America, let's say, Daewoo borrowed $100 million from Bank of America, let's say, okay? I owe you $100 million, but they went bust, okay, bankrupt. Now what happens to this loan amount they did not pay yet, okay? Obviously they cannot pay the 100% of this amount. That's why they declare bankruptcy in the first place, right? What's the choice? Ex post, right? I call it ex post. Here's a timeline, okay? And then here's a time point of declaring bankruptcy, BCY, okay? And ex post is after the fact post, okay? Once they declare bankruptcy, ex post. And then in contrast, the time point or the situation before declaring bankruptcy is called ex ante, before something happened. Ex ante versus ex post, okay? Is very important distinction in economic discussion, right? Beforehand or afterwards, right? Ex post. Once you declare bankruptcy, okay, what happens is the next question. Is the next question. And ex ante, you should not declare bankruptcy and then you should repay the debt, principal amount, 100%. Repay the debt as much as possible, right? To the full, right? That's ex ante. But ex post, once you declare bankruptcy, now what is a question, right? The thing is, this international bank, right? They have a choice. One is ending up with nothing, okay? The company can be fully liquidated. Maybe after liquidation, only a small fraction of the IOUs will be repaid, or nothing at all. In case what they lent is subordinated debt, okay? Sub-debt we call it. Subordinated. 후순위 채권, right? Sub-debt. No chance, no soup. 국물도 없어요, right? So no chance. Or another alternative is you get a discounted payback, deep discount recovery, deeply discounted recovery. Okay, recovery. How does that happen, right? Recovery. Um, Perhaps in industry they say recovery rate is usually 30 to 40% of your principal amount. 30% of this, right? Or part of it, okay? In this numerical example, it will be like 60% recovery. Okay, let's see how it unfolds, right? Essentially, this recovery process, right, can be any of these two. One is liquidation, okay, total liquidation, as I said before. Sell off those collaterals if you are senior debt holders. You have collateral of factory is collateralized. Well, sell off those factory to some like Hyundai Motors or GM who wants these factories, right? Equipment, sell it off, right? As a banker, and you're gonna do a fire sale, okay? At a deep discount rate. That's one thing, liquidation. The other is selling off this company to a potential buyer as a whole, selling off the company as a whole, right? Is there any multinational corporations like GM or Ford that may want to take over Daewoo's Daewoo company itself as a whole, instead of factory or the machine, the whole company, they buy it, okay? Or any kind of private equity, okay? Or distressed asset investors, right? Private equities, they are interested in this kind of distressed companies, right? Their job is to purchase it at deep discount and then restructure it and then sell it off maybe 5 years or 8 or 10 years later on at a higher price. Private equity companies, right? The Bank of America, may want to sell off this kind of loans to loan to this kind of private equity companies. That's one thing they could do if the loan amount is big enough, so that the you become, essentially the debt holders, the Bank of America may become the shareholder of this indebted company, the bankrupt company, okay? Because they did not repay the bank, to the bank, the bankers become the shareholders in that emergent situation, and then this bank sell it off to private equity, okay? There are special functions in the banks that specializes in this kind of situation. We call it special asset group or distressed asset group. They have many of the major banks have this kind of functions there.